The February 2024 Catalyst Funding Real Estate Market Update. Happy leap year to everybody on leap day or whatever you might call it. But we're here to hopefully help you with your real estate investment journey. And I want to introduce our speakers for today and then our special guest, and then I'll turn it over to them for all the latest knowledge on the Texas and national real estate markets. So first of all, the founder and CEO of Catalyst Funding, we have Wade Comeaux.
Hello, everybody.
And we have our director of lending with us today, Jeff Johnson. Hello. And a special guest from Lifestyles Realty, Inc., Jeff Smith.
Hello.
I'll let Wade speak to our relationship with Jeff, but I'll first offer this quick disclaimer that this presentation is for general information only, and no information or documents or estimates presented in today's real estate market update are offering any final determination or investment performance. Basically, we're saying that there's no guarantee on any rate of return on investment, profitability, that we're basically here to present great knowledge so that you can use it to influence and let it speak to your real estate investment journey. But everybody here is not held responsible for any loss or damage. So there's our little disclaimer. Obviously, I'll be back at the end of today's webinar because we always have a winner of a drawing for half off a hard money processing fee. You have to be present to win. And with that being said, let me turn it over to the guys and they can get going on this month's market update.
Thanks, Derek. And before I turn it over to Jeff to tell us a little bit about what is going on in his world, I'll say that I think Jeff is just a huge impact in the local real estate investment community. You know, Lifestyles Unlimited is arguably the biggest mentor of real estate investors in the country. Jeff leads the agents for almost certainly the biggest location of Lifestyles Unlimited. So he has a huge impact on real estate investors, not only in Houston, but so many people outside of the Houston area invest in Houston. So he's had a huge impact. He always has great insight, and he's arguably my favorite guest whenever we have him on because he sends so many outstanding reports that we may not always cover. And Jeff always has, man, you got to put this data point in there, this report, and it's always adds great value. So Jeff, can't say enough great things about you, and tell us a little bit about what's going on in your world at Lifestyles Unlimited.
Yeah, great, thanks. So I think you guys have me on once or twice a year. It's always a great time, so thanks for having me back. As far as what we're doing at Lifestyles Realty, I think that you say arguably the biggest or arguably the best. I don't think it's arguable at all. But you know, here's how I back that up. You know, we have 40, 50,000 clients, and I think that our group of real estate investor buyers is the most qualified, the most educated group of buyers. It's a group that exists anywhere in the country. It allows me to recruit and, more importantly, retain the top investor-focused real estate agents, I think, in the country. I would put my team up against any other group of investor-focused agents anywhere in the world. In fact, I'm not the only one that says this. I mean, the current number one producing agent, as identified by the Houston Business Journal, works in our firm. The number 9, last year, the number 9 ranking most productive agent works in our firm. The number 10 ranking agent works in our firm, right? 3 of the top 10 producers in the city of Houston are all in the same place. And so, you know, we just had 2 more get nominated for this year. So we're confident that if, you know, anybody looking for investment property that comes to us is going to own investment property or additional investment property in the next 30 to 60 days.
Yeah, and one thing I'll add to what Jeff just said is there are quite a few organizations that have very good education. I think Lifestyles Unlimited is really differentiates itself, but arguably the biggest way I think you differentiate yourself is the delivery of opportunities that are consistent and strong. And that's where we see some other groups may not be, and I have to be very diplomatic here because we have a lot of guests that we really appreciate. But I will say the deal flow that we see coming through Lifestyles Unlimited to the borrowers that we work with is significant. And that's where the rubber meets the road, because investors don't just go to be educated. They go to be educated and do quality deals. And Lifestyles is a machine in that category.
Yeah.
Some of my colleagues across the industry, I mean, are on our guests on this program. You guys do this every month, and I know a lot of them. I might even say all of them, but and I respect the heck out of all of them, and their knowledge. I just am really confident in my team.
For sure. Yeah. Outstanding agents. I mean, some of them, like the number one agent, been with you probably, I don't know, 10 years or so, something like that.
He's been, I think 15 years.
15. Okay.
He's been in the top 5 7 times, and the top number, then the number 1 guy the last 2 years, and probably 4 times.
Yeah. He's a machine for sure.
Yeah. You guys do a great job of bringing deals. Like you said, there's a lot of, not even just educational groups, there's just a lot of networking opportunities and things you can go to, but like they bring deals. That's your job, right? Lifestyles Realty. You have an entire division to help people actually accomplish the goals as opposed to learn about the goals, right?
Well, yeah. Now I'm bragging about my team because I'm on the team that lead the team that helps people execute what they learn. But they wouldn't be able to execute effectively if they didn't learn the material that Lifestyles Unlimited, the sister company, the company I'm with, teaches them. And so kudos to the educators and all of the people and the mentors and everybody over at the, on the education side of our group of companies that, because, it's a team effort, and I just, since I'm focused on the acquisition piece of it, I brag about that all the time.
For sure. Well, let's dive in. I will briefly cover the Catalyst value proposition. I just want to cover a couple things here. One is that we do pride ourselves on being a one-stop shop for hard money and permanent financing. We think our secret sauce is in this space for buy and hold long-term investors, which is also really the business model and core focus of Lifestyles Unlimited. We do a good job with flippers, a great job with flippers, but we have some very unique things in the space for buy and hold investors. We can get you pre-qualified for both the short-term hard money to purchase and repair distressed real estate and the long-term stuff with one soft credit pull. That's a really big thing because protecting your credit score is an enormous impact in qualifying for loans and getting the best possible pricing. We also have 5-star customer service across all platforms, so definitely keep an eye out for that. And then we'll just dive right in. That was the brief things I wanted to cover there. All right, and this is in your neck of the woods there, Jeff, back in Houston. So Jeff Smith, tell us a little bit about what you see in the numbers.
There's a lot here. So I'll start with, I'll start with the inventory numbers. The months of inventory, this shows 3 different years. This shows this year, last year, and the last pre-COVID year, 2019. And I don't, for any of you who have been doing this for a while, if you remember in 2019, we were complaining about how bad inventory, how little inventory there was at 3.7 months of inventory. Now, 6 months is what is industry-wide considered to be a balanced market. Anything below that is a market that's in the seller's favor. And, at 3.7 months, we were freaking out about how little inventory there was. And then it went down from there, right? When COVID happened, everything went the opposite of the way we thought it would. And so there more demand hit the market, not less. There was a 2 or 3 or 4 week period where there was uncertainty, but after that it was blowing and going. And now we've had an increase That's a 25% increase in inventory, months of inventory, yet it's still below where we were freaking out about it being low. And so the demand is still strong, even though sales have come down from recent years. We're still in a very strong market. The second thing I would point out about what we're looking at is the pending number. We've had an increase in pending sales from last year. That's a forward-looking number, and that tells you that there's going to be some more stress put on inventory, provided interest rates don't increase too dramatically. The third thing I would point out, and there's four really. The third thing that stands out to me is the prices are up about half of what they normally are. The Texas A&M website, the real estate center there, they track it all the way back to 1990. And if you take an average or a median, you're going to get a range of 4.2 to 4.8 months, or I'm sorry, 4.2 to 4.8% year. And so we're about half of where we normally are, but a fraction of where we were post-COVID. And if there's some relaxation in rates, or even certainty, right, even steadiness, we're going to see demand come back into the marketplace. Maybe not pushing prices as high as as fast as they did pre-COVID, but certainly upward pressure. The last thing I'd point out about Houston in particular is that even though we're the 5th largest metro area in the country, if you take the top 20, and I get this from the Greater Houston Partnership, great resource if you look at their job is to sell Houston to businesses, right? But they point out on their site that we're the 5th largest metro, and if you rank the top 20 in population, or you take the top 20 in population and rank them by housing costs, Houston is second most affordable out of the top 20 MSAs. With the migration we've been getting, how long do you think we can sustain that we're going to be the 5th largest market and the 2nd cheapest in housing? Unless we can build property a lot faster than we've been building it so far, we can't sustain the affordability level we're at. So I would anticipate stronger than 2% increases, moving forward.
I think you're muted, Wade.
I had to mute. I think we had some background noise. Maybe it's not on my computer, but sorry about that. But I think the point I was going to make is, if you really think through how home prices have not gone down and interest rates have gone up this enormously, it's really shocking. I think even the most optimistic said, and I was pretty optimistic because I knew the demand numbers and the lack of inventory, so I was pretty optimistic. But still, I thought there's going to be some slight reduction. Maybe not significant, but that tells you how much demand is out there. There's not enough inventory to keep the gross numbers really high, the total number of sales. But the fact that values haven't gone down whenever it's exponentially more affordable to buy the exact same home is really a testament to where we are. And the exciting news is, for people who are buy and hold investors, is that whenever rates do come down, it's almost impossible to craft a scenario where home prices don't go up a significant amount whenever rates come down, because you're just going to be able to afford so much more. Jeff, anything to add before we go on to Dallas? That was a very great coverage there of Houston.
Yeah, I do. I will add this. If you ever follow the Altos research guys, I subscribe to their product. I'm a big fan of the data that I can get from it. And one of the things that they make easy is to divide the market into quartiles. So you have the most affordable quarter of the market, the bottom, and so forth. And if you look at the median price of the bottom quarter compared to the overall market. You can see that sometimes the overall market the median price will dip below what it was last year and then pop back up, and it moves back and forth. The bottom quarter of the market so far never has. And so, I'll talk more about this in a little bit about why we target the properties we target, but it's almost always in that bottom quarter. And so there's a lot of strength there. When you're a buy hold investor, you're buying properties that the median income household can afford. There's pricing stability there that I think is just built in, but it's very hard for the bottom of the market to fall.
So if you have those requirements or guidelines for what you're looking to buy, like, do you ever run into a situation where you have a hard time finding enough inventory at that level?
Well, yeah, inventory is down. I mean, the reason that I have the job I have is in 2013, 2014, I was the only Lifestyles person doing off-market transactions with wholesalers, right?
Really?
Back then, wholesalers had a terrible reputation, and we were coming off of, inventory. Most of our inventory came from bank-owned properties, right? From asset managers and things like that, and we saw inventory dropping at that point. And since I had access to off-market opportunities, I was put in the position I was to help get the whole team moving in that direction. And the way that Dell describes it, that Dell owns the Lifestyles companies, he uses the analogy of a water balloon. You squeeze one end, the other end of that balloon is going to expand. And as far as inventory goes, if the sources we're using are struggling, we'll find another place. We're smart, resourceful people, I think. And we have access to smart, resourceful people like you guys, right?
I do have a question about one last question, then we can move on to the next slide, because I was looking at the numbers. So if you look at the single family home sales number, that 5,009, relative to how many active listings there are. I looked at each city, like as a percentage, like which percentage of those listings sell, right? Because back in the day when things were hot, like that was a huge number. I don't know if it was 50%, I don't know what it was, but it was large. And despite Houston being resilient and there's good numbers here, relative to its peers, it's the lowest number, like as far as a percentage of sales. So there's a lot of listings and a lot of sales, but the percentages are much lower than, like, say, like Dallas is more like 28%, like they're flying off the shelves relative to the listings. So do you think it's just a massive listing number is driving that, or why do you think we're able to have lower, I guess, turnover, but the values are still really strong?
Well, first of all, Dallas is a bigger market than us, even though it's a smaller city. The DFW market, I mentioned that Houston is the 4th largest MSA in the country. Dallas is the 4th. Houston's the 5th. Dallas is the 4th. Dallas, as far as Houston goes, I'm not sure why. It's a function of inventory, right? I mean, our total active listings are up considerably, right?
Total listings, yes.
Inventory is growing.
Yeah.
And here's the thing: we're at the seasonally low point for inventory, so inventory is going to rise. And my opinion is that if the Fed cares about real estate, and that's a big if, right? I don't necessarily believe that they care about housing very much. But if they did, they wouldn't lower rates at this low point, at the seasonal low in inventory. because that's just going to build you. Well, we talked about it just a minute ago. It's going to just increase the demand for it. If we're at the low point in inventory, then we're right back to multiple offers on every single property we make. And I think that's really where we are. A lot of the folks who are in single family buying are accustomed to lower than normal interest rates, and they're in a pause mode. And so sales are slow relative to where they were, to your point, relative to where they were as a percentage of total inventory in years past.
I mean, I'll just make one other point on Houston versus Dallas, though. If you look at pre-COVID, there were 4,100 sales in January of 2019 in Houston. Last month, there were 900 unit increase. Dallas had 5,249 sales pre-COVID, and they only had 4,970 in January.
Really? And they're a bigger market than we are. That's interesting.
Yeah. So, I mean, at the end of the day, there's a lot of numbers here that our months of inventory is a little bit higher. Days on market is basically identical with Dallas. The thing that is the biggest difference is the overall appreciation in Dallas has been pretty unprecedented. That number's been consistent, and Houston has not grown to that level. But it's still, in many ways, a more attractive rental market because the prices are lower and you can get the returns. It's very hard to get the returns anywhere in the major parts of Dallas. You have to go outside of it. They're really focusing on the tertiary markets up there. Let's go to this next slide. This slide is talking about the single family rental rates. And then, what's really interesting to me is the lease listings under these price points are just down significantly. Go ahead, Jeff.
So we focus on serving the median income households right around that and below, right? And in Harris County, the median income is just over $60,000 a year. That's $5,000 a month, right? And HUD says that what's affordable for someone to pay for housing is 30% of their income. Well, if you're making $5,000 a month, that's $1,500, right? And so really only 7% of the entire rental market, single family rental market, is affordable to the median income household. If you're buying properties that rent for $1,500 a month, people in that market segment don't have a lot of choices. You shouldn't be experiencing any kind of material vacancy if you have something that's in that much demand and that little supply.
Yeah. You would have there'd be some rehab or pricing issue. To your point, it just doesn't make sense because there's so much scarcity. If you're having significant vacancy, you need to really evaluate the condition of your property and or the pricing.
Yeah, it can be three things. Those two, and you can have a crappy salesperson, right?
Sure.
I've met landlords who are trying to lease their property, meet people at the door and practically give them a proctology exam, with, you're not going to move into my house if you smoke or if you missed a payment on your credit card 12 years ago. I mean, you've got to have some salesmanship ability, or at least you can't scare your people away, right? You need to make it easy for your prospective tenants to lease from you. Obviously have common sense, your standard screening criteria, but I wouldn't lead with that. I would lead with, man, this property is a great property for your family.
Yeah, for sure. Anything else on this slide before we move to the next one?
No, the HAR puts out this report every month, so it's something that we follow pretty consistently.
The only thing I'll notice is if you look at the total active listings, 6,500 versus 7,400. So there's a lot more active listings in 2024. But if you look at the price cohorts, 2000, 1750, and so the prices are way up, right? Just look at there's more listings, but there are fewer listings at that price or below. So rents have gone up. When tell people, when lately, especially when rates are higher, people are less they're skittish, like you said, they're on pause. They don't want to jump into the market. So, well, I get that, but if you can weather a small to no cash flow, everything's working in your favor over time. Leases go up higher than property taxes by a pretty significant margin. A lot of people turn over a year, 2 years. Plus, like Wade said earlier, if rates drop, there's the refi that you can have an instant increase in your cash flow, right, about a couple $100 sometimes. So if you can get through the times now and buy properties that are cash flow neutral or small cash flows, it's happy days going forward, because I don't see rents going down anytime soon.
I don't either. But that's projection. I'm going to buy based on the numbers today, and we're still, even though 2 years ago we were clearing $500 a month on a property leveraged at 75% of its value, right? Today it's in the low 200s. So yeah, you're taking less cash flow, but you're getting double the equity capture in our market in Houston. So that's a fair trade, I would say, right? I would
return on cash.
Yeah,
returns on cash in are way higher.
Yeah, I'd $100 a month cash flow for $25,000 in equity any day.
Yep. ROI is the key thought here, right? And then that's the big driver, how much you're out of pocket versus how much cash flow you can get. Then the other big factor, your point, is that equity capture number, which is huge. And back whenever people were getting these deals with big cash flow and very attractive interest rates, there was nowhere to go down on the interest rates where you would just have an automatic increase in your cash flow. We all think the timing is definitely up to debate, but these rates are eventually going to go down, and then you'll be able to see much bigger cash flow, and you're not going to give up that equity capture, and you're still going to be in that same solid position with a lot of equity in your property.
Yeah. As far as rates go, isn't it interesting how people think that what's normal is what it was when they started? And so, when I started investing in real estate in it would have been early 2000, right? My first interest rate was 9.9%. So to me, right, 8-9% is totally normal. But somebody who started 5 years ago, that seems ridiculous.
Yeah. All right. So this next slide really just showing that the active listings are up significantly. That is interesting.
They are. So
even
though the pending, like I mentioned earlier, the pendings are up. The new listings are up more, right? So let's say that we have the same number of closings moving forward, and this trend continues. We're going to have inventory growth, which is in a world where we are at 3.3 months of inventory. In my opinion, that's welcome news. Because we're buyers, right? We're looking for more choices, and this looks like inventory relief to me, and I'm excited about it.
Yeah, for sure. I think we've covered Dallas. Houston well. We're at the midway point, so we got to cover a couple other cities here.
Okay.
Let's dive into Dallas, which, as we mentioned earlier, is definitely the hottest area as far as appreciation goes. But a lot of the other numbers look really strong as well. What do you see here, Jeff?
I can tell you what my counterpart in our Dallas office tells me. All right. Because I still get people from the Dallas area investing in the Houston market. And he doesn't understand why. And his point is this: for the same cash out of pocket or relatively close, he can provide buyers with 25 to 30% higher equity captures with the same cash flow and a very similar out of pocket number. And their sales are increasing considerably. I mean, you look at this one; they're up 15%. And our buyers in his office in Dallas, I mean, they're excited. Their numbers are way up year over year, and the quality of what they're buying has never been better.
Yeah, we see we do quite a few deals up there in Dallas with Lifestyles Unlimited in particular, and it seems like they're just going a little bit further outside of the city, in that North Dallas area, all the way into southern Oklahoma across the border, incredibly hot, and those people can still commute to outstanding jobs. A lot of the core corporate jobs have moved north of Dallas, like that, McKinney, Plano, Frisco, that area has tons of, Fortune 500 corporate headquarters there, really quality jobs, and then other quality jobs feed off of those jobs. So that economic growth in the North Dallas area has been pretty impressive.
Yeah, well, I mentioned Houston being the 5th largest MSA. Dallas is the 5th. And while Houston is more affordable at being the 2nd cheapest on that list of the top most populous, the 20 most populous MSAs, Dallas is 8th from the bottom, right? So they're 12th to 13th on that list of 20, but they're still 1.6% below the national average in terms of housing costs. So even though a Houston buyer looks up there and says it's expensive, it's, in the bigger picture, they're right at the national average in terms of housing costs, and they're the 4th largest metro in the United States. They're going to have appreciation. There's going to be opportunity moving forward for them.
Do you see a world anytime soon where that market, if it keeps as hot as it is, it turns into like an Austin market where it's difficult to have any kind of cash flow on single family and you have to move into duplexes or smaller stuff?
Yeah, I think all of those markets in the top 20 are headed in that direction. I mean, especially the 3 Texas markets, the points of the Texas triangle, whatever they call that thing. I forget there's some term that they call the Texas triangle, but I mean, the migration patterns toward that Texas triangle are so much higher than we can produce additional single family housing. So it's going to force those prices up, and both in sales and rentals. So yeah, I think we're headed that way. Dallas is probably closer to hitting that than Houston, but we're both approaching that situation.
Completely agree. Yeah. Let's look at San Antonio, which I would say is a more similar to Houston than Dallas would be in many ways, in that, the homes are still more affordable. Even in the more centrally located parts of town, you can still get cash flowing properties. I will say that San Antonio has a higher months of inventory number and higher days on market, and the year over year price growth is not as positive as it is in some of the other spots. But I do think that there's still a real opportunity in San Antonio. And another interesting thing is we often have national prognosticators that come on, that not on our show, but that will talk about articles that they've written. And San Antonio consistently rates at the top, in their opinion, future appreciation and good places to invest. So even though it seems a little bit softer at the moment, what's your opinion of San Antonio?
I'm very positive on San Antonio. Now I was surprised to learn this, and what was it, 2 or 3 years ago, whenever the Greater Houston Partnership started putting that housing number on their website, I got really curious about San Antonio, and they're not in the top 20 MSAs, but they are the 7th most populous city in the country. I didn't know they were a top 10 most populous city in the country up until just a couple of years ago. And I'm 51 years old. I don't how and live in Texas. How in the world did I not know that about San Antonio? But their rent growth has been slow. So, you know, they're not experiencing as high cash flows we are here in Houston. But being the 7th largest city in the country, and it feels when you're there that this isn't a data observation, it's just a feel. It just feels like a smaller place when you're there, even though it's a big city. And their housing stock is older than ours. And I just think that I think that this where they are right now is is temporary, right? I mean, my counterpart there says they're consistently getting, low to mid 30s in terms of thousands of dollars of equity capture on every transaction, or in their median equity capture, I guess, would be mid 30s. Their cash flow is a little less than ours. That's because their rent growth has been slower. I do think though that their operating expenses like insurance and taxes are lower than ours, and so that's why they're able to cash flow the same as us, even though their rent growth has been slower than ours.
Yeah, I look at San Antonio and I'm always confused as to why it's not more valuable, because the income is like, if you look at the average income, it's about the same as Houston. Like it should be more expensive, to be honest. So yeah, I think there's really opportunity there to get some values.
Enough of us are going to see that over the next year or two and move our money there and change that dynamic, I'm sure.
Yeah, that's why I think there are so many articles that those numbers are not difficult to decipher and see that there's real opportunity there for sure.
You just mentioned Dallas growing into the tertiary markets. If Austin does that, you're in San Antonio.
Yeah. But you have a lot more amenities than, no offense to rural southern Oklahoma, but you have a lot more amenities than San
Right.
All right. So after San Antonio, we have Austin, and Austin is an interesting story too. The total active listings is way up. January 2019, very hot market. It wasn't super hot a year ago, but there was a time when it was absolutely the hottest market in the entire country with all the California money moving there. But if you look at the year-over-year prices, down about 20%. It did have a huge increase earlier than that, of course. And still the number of the median sales price growth from pre-COVID is about the same as Houston, definitely below Dallas, a little bit above San Antonio. But I think the biggest things you see are significant increases of months of inventory, significant increases of days on market, and just a market that is not as hot as it was before. But still, a lot of those national prognosticators are very positive on Austin, not necessarily for a buy and hold single family rental market, but in the area of appreciation because of this. Their income on average is some of the highest in the country, and these prices have still not caught up in the overall scheme of things. They had a lot of tech jobs move in there. Their average income is, we'll look at it at the end of this presentation, but very, very high relative to the overall prices.
Look, we're buy and hold folks at Lifestyles, and it's difficult in Austin to make a single family property work. We do have a couple of agents who focus on Austin that work out of our San Antonio realty office, but it's just harder. It's a more expensive place. We work with, we cater or serve the median income households and below, and it's tough. When we do have investors buying in Austin, they're doing exactly what you you mentioned. They're buying it as more of a covered land play than anything else.
Yep. Next slide. We got a lot of slides in about 20 minutes. Although this one's pretty interesting. So this is a percent, I don't know if you saw this or not, Jeff, but it's a percentage of market share bought by investors. So if you look at this chart, they have it broken down by price, like low, medium, and high. You would think they would always be a larger percentage of low, which they are, but it is 2024, I guess the Q1 of 2024, it's the highest it's ever been on the low end of the cohort. 26% of all low price homes are bought by investors. So to your point earlier, I guess people are kind of catching on.
Well, yeah, they're catching on. Plus, I mentioned the Altos data giving me the ability to break it out in one click as opposed to, trying to separate it out in multiple steps using hard data. But it's why it's important to me to break out that lower segment, is because it behaves differently. I've had former clients who get into real estate investing and see how competitive it is, and then look at their home equity in their $1 million house and think it's going to be just as competitive if they put that on the market, and their $1 million house, the different segments of the market can behave differently, and that's why you often need to evaluate certain metrics separately.
Yep, for sure. Next slide. So this is interesting. Yeah, go ahead.
The cash buyers really put a floor on prices, right? I mean, if the prices that are attractive enough for cash buyers, that's as low as they're going to go.
For sure. And, I actually have spoken with a few people. I've done some passive investments in other categories. And a lot of people in the multifamily space are saying, they're building up war chests right now to be cash buyers, because there is distress in both commercial and multifamily because of the NOIs and higher taxes, insurance, and increased interest rates. So they really feel like there's opportunities. But to your point, if you're buying with financing, it can be somewhat difficult to make some of those deals underwrite properly and pencil. But if you're a cash buyer, everybody knows those are eventually going to go up. It's just a matter of, especially the interest rates, but maybe insurance coming down as well. Some other factors like that I think are inevitable over time. And then you're going to have fantastic deals. I mean, the buying opportunity you have right now in all categories is very, very strong. But not everybody has the cash to do it. But when they're swooping in like this, that is a very positive sign. You think back to 2014, that was also a market when many people were afraid, but everybody would now call those people the smart money that were buying from like 2009 to 2014. They did really well.
Yeah, oh, definitely. I have a question for you. You're in the finance business, and this is just a theory of mine. This is a Jeff Smith theory, not a Lifestyles theory. This is my own curiosity. So you remember the mortgage credit availability index we were looking at earlier? We saw that big rise, we were talking about it offline. Is that coming up? Did we already?
Yeah, it's a few slides down.
Okay, all right.
It's a lot of slides down, but
we'll get there. We'll make sure we get to that one.
Okay, all right. I mean, my question really for you guys is multifamily exiting their version of subprime availability with a lot of variable rate loans in play that were short-term products and such. And, if they clean those out, is multifamily poised to do what single family's done over the last 10, 15 years?
I would say that, yes, there were a lot of syndicators who were very aggressive and probably highly leveraged in a lot of situations, and they were trying to extract every bit of ROI by having floating loans, not only on their bridge financing, but even on their permanent financing. But the people who were more savvy, more experienced, definitely were trying to lock in those rates. They may not have always been able to lock in 30-year fixed. That's kind of a rarity in most of those environments, but at least getting 5 or 7 year locks. And but there were a lot of people, to your point, who were not doing that. They were like, I can get, you know, a quarter or a half point lower on the interest rate, and I'm going to go ahead and float, with that optimism that comes from rates not going up in so long. And then a lot of those people, those are the ones that are really struggling, right? The people that had the 5 or 7 year locks, not all of their portfolio is going to be coming up on a renewal at the same time. They can weather the storm on a couple of deals, do some cash calls, inject some of their own cash, and get through that. The people who are floating on everything, and you know, if you've been around in the multifamily investment community in Texas, you know who a lot of those people who were very aggressive were, and those people are definitely struggling a little bit. But the people who are more savvy, syndicators and leaders that had them locked in, I think they're going to be fine. But there are going to be distressed properties coming on the market, to your point.
Yeah, well, and also a change in what loans are available or sought after. And so, you know, if that's the case, much like, you know, we had a big change with COVID, and the property owners or the borrowers didn't really have to struggle that much. The next time this happens in the multifamily world, it'll be different, much like it was for single family in this cycle.
Yep. So I know we're at 1247. Let's look at that particular report, if we can get to the one that Jeff was speaking to. I do think it has some.
I think we were just on it. The mortgage credit one? There it is.
Yep.
Yeah. Why don't you speak to this one, Jeff?
So this report to me is very telling. If you the report was indexed to 100 in 2011 or 2012. I think it was 2012. So that was the standard, was, you know, whatever mortgage credit availability was in 2012, that became measured as 100. And moving forward, they're looking at, all right, if we get too loose with standards, or rates get lower, or or all these exotic products come onto the marketplace, it makes it easier to get financing or mortgage credit. And so it got up to 200 from 100, going from 2011 to 2020 or 2020. And then COVID happened and it fell again. And then we had a banking crisis and it fell again. And now it's in the 90s. So it's less, there's less mortgage credit availability today than there was 12 years ago, right? But prior to that, you know, when subprime mortgages were all the rage in 2004, 2005, 2006, look, you know, that's that big giant hump at the beginning of that chart there. That was a lot of people getting, you know, a lot of availability, I should say, for mortgages in the marketplace. And a lot of people who borrowed back then were one flat tire away from economic catastrophe. And you know, the economic catastrophe that came was more than a flat tire. And so that's why we saw the distress in the single family world that we saw. And since credit hasn't been as easy, even close to as easy as it was then, the people who are property owners now, 40-something% of them don't even have debt on their property. But of the 60%, 56% that do, they're more qualified borrowers, higher credit scores, more cash reserves, and a lot more equity in their property. Yeah, stronger employment, all the things you guys do to qualify somebody has been stronger over the last 15 years. These are not people who are a flat tire away from economic catastrophe. They're, you know, all of the things that have to happen to create distress to the people who are real estate debt holders today takes a lot more time than people think for them to get through all of that to become distressed sellers. And so while we'll see, our distressed percentage go from, we were at what, 20-30% of the market was distressed 15 years ago, and today it's 1%, right? And last year it was 0.5%, and people are it's talking about how it went up 100%. It went up from 0.5% to 1%. Sure, that's doubling, but it's still a 20th of what it was. So I would caution a lot of folks to dig a little deeper than just the headline, because there's not a lot of single family distress.
Yeah, people that we hear this often. We had an event last night, and you'll hear people saying, yeah, I want to get actively involved, I'm just waiting on the market to come down. And I always tell them, how long have you been waiting? And
Yeah.
I've been waiting for a couple of years now, and I'm like, you're going to keep waiting. It's just, there are no indicators that say that's going to happen. And I want to tag on to one point you were talking about, to just, whenever people see a chart of like expanded credit, that chart is really big, but I want to describe a few products that were out there. There were actually products where people could state their income and have a negatively amortizing loan with FICO scores in the 500s. So you could say, I make 20,000, no proof. You could have a loan that actually went up in balance every single month, and you could do it with an incredibly low FICO score. That's how bad it was. And there's nothing like that in the market right now. There's no neg AM loans. If you're an owner occupant, you have to prove your ability to pay. It's just a totally different environment. So to your point, I'm not sure where the distress is really going to come from. And the point that you were making earlier, waiting on the market to come down is really a mistake, because it's just not going to happen. But even more importantly, if the market comes down, you're still going to be borrowing at the same percentage of this new value and not really get something that's overly attractive. Your cash out of pocket is going to be comparable. What you're getting right now, which is really unique, is very low cash out of pocket, because a lot of people are overly fixated on the cash flow. There's not quite as much competition. Really, the people we see buying right now are the more savvy investors, because they're not just worried about cash flow. They understand ROI is really the driver. Equity captures a huge component of this, and the fact that rates are high and you can still get quality deals means that when rates come down, they're going to be better. So that's really what we're seeing now.
Yeah. We have like 7 minutes, so I think we should probably just pick and choose a few slides. I don't know, Derek, if you want to go to 16, I thought maybe that would be something Jeff could talk about, because it focuses on rents and cash flows. That one right there. Just talking about single family rents up 3% year over year. I do think it's interesting, that gigantic spike. If you see basically right around COVID, it's obviously coming down, but if you look at the tail end, it's starting to curve up a little bit. So other than just, hey, regular rental prices are going to rise, Jeff, anything interesting you see or not?
Well, yeah, I mean, so since 2010, every year has been a positive number, right? So we're talking about percent change, not I mean, that line, even though it's a declining line from 2022 until recently, even though it's still a positive number. So, you're talking about a 2 to 3% increase in rental rate, which if you follow that all the way back, most of the time, this is just a hair below normal. You haven't seen decreasing rents since 2010, and even then it was just for a year and 2 or 3 months. Most of your leases are going to last longer than that, or about that, right? And so your existing tenants, you may have one cycle where you have a lease that is $25 or $50 less than the previous lease. If that tenant turns in that year. My average tenant stays 2 years and 9 months. And at the price point where my rental properties are, you saw the demand from the slide earlier. If it's vacant for more than 2 weeks, I'd be surprised. And so if I have 2 weeks of vacancy every 2.5 years, that number is really negligible from that perspective. And if I'm getting a 3% increase every year, and I started in a good place, I'm happy as a clam.
For sure. The next slide is actually pretty good too, and then we'll move on to, I think, the affordability index, but there's a positive note on national rent rate increases. Houston is very positive at 3.9% relative to the other major metros in the country, with Dallas and Austin actually being down, which is interesting. But let's go to the affordability index. That's kind of centered around what we've been talking today. I think we could wrap up there.
Okay.
What are your thoughts on this? We had the pre-COVID last year and this year.
Yeah.
What do you think, Justin?
So the affordability is the starting point for where we decide what we're going to go after, right? We look at what the median income family can afford, and what's this in Houston? On this chart, it's just over $60,000. Dallas, $65,000. You pointed out Austin earlier is $87,000 in household income. You take, how do we qualify our tenants on either 3 or 4 times the rent, right? Which is right there in the middle of that HUD affordability ratio at 30%, is right there in the middle of that number. And this is where we start. This is how we determine what market segment to target. Where can we buy properties that the median income household can afford? Now, the median income for a rental household is probably even lower than that. And so, you've got a large group of prospective customers and a very small segment of the market available to them. And so that's where we like to be. And this is the starting point for making that determination for us.
Yeah. I always like to look at the trend line on affordability. I think it's pretty interesting as well. And how, Houston pre-COVID was the 29th least affordable. Then it went to 43rd. And now it's 32nd. So it's kind of interesting how it's bounced around a little bit. But it is more affordable today relative to the rest of the country than it was pre-COVID, despite enormous amounts of people moving into Houston. Dallas went from 22nd to 25th. So it's also an improvement there. So despite enormous amounts of people moving in to Texas and some of these major cities, they're still more affordable relative to the other parts of the country, which is really, really incredible and should just continue to push so much of this migration into the state of Texas. All right. I don't think we have any time to cover questions today, but I just wanted to see, Jeff, do you have anything in summary? Like if you were going to give a couple pieces of advice to single family 1 to 4 investors, that's kind of your bread and butter area in the state of Texas. What are 2 or 3 nuggets that you would like to give everybody as advice for 2024?
Absolutely. Well, I started 25 years ago, and I started because I had a mentor. And I would encourage anyone, I think that's the biggest piece. Find a mentor, start with a mentor, and the very next thing that mentor is going to tell you to do is, in addition to learning the material, learning the basics, they're going to say build your team. And 2 of the very first team members that my mentor advised me to get are guys like y'all and guys like me. Find people who are investor focused service providers and are in the top of our field. And so, that's where I would start. Find a mentor, because I know that mentor is going to guide you, if they're worth their salt, to guys like us.
For sure. That's a great one. Well, instead of 2 nuggets, 1 powerful nugget. So that was very good. I agree. I mean, like whenever I first got started, I had mentors as well. And I can tell you the first time I went in to buy a property, I was still incredibly nervous, even though I'd been in the mortgage industry for 15 years then. This is my first investment property. I don't know homes, other things like that. Even with a mentor, it was a little bit intimidating, but it was so much better because I had someone to bounce questions off of, concerns off of. And, honestly, I don't ever think I would have had the traction or the momentum to build a pretty large portfolio without people who were helping me along the way and telling me the mistakes they made, the successes they had, all those things. So it's enormously powerful to have mentors. And Lifestyles Unlimited has so many things that are great, not just mentors on staff, but hours and hours of recorded videos and training that you could do at your leisure. It's just a powerful machine for helping you succeed. No doubt about that.
Yeah, you talk about it being scary. The first time I was at a closing table, the title company's closer slid a promissory note across the table for my signature, and all I could see was I owe you $50,000, and that was a very large number for me back then, and the IOU part was terrifying. So I slid that right back, and and she was cool about it. She says, "Oh, I'm sorry. I didn't realize you were bringing cash." And so I ended up closing on that property. And hundreds of properties later, I'm happy to be here.
No doubt. No doubt. Well, Jeff, as always, we appreciate it. And you mentioned earlier we have you on once or twice a year. We are going to do a little bit more narrow group. We find you and a few others really make a huge impact on these calls. So you're going to hear from us a little bit more regularly this year. And hopefully you're able to hop on because you make a huge impact. We get tons of great comments from people who watch the webinars whenever you're on. So can't thank you enough.
Thank you. It's it's fun to talk real estate, and there aren't very many forums where it's welcome. So I'm happy to be here. I can't just go to hang out at the park with the other dog owners and
Yeah, you'll sound a little bit like Charlie Brown's teacher to a lot of people, right?
You
They're
could.
noise.
You may not last very long.
all right.
All right. Well, have a great one, Jeff. Good luck to you this year. We'll talk soon. Thank you.
All right.
Thanks, Jeff.